All right, welcome back everyone. So in my last video, I already mentioned the only valuation metric that BIA uses and we ask our members to use is this price to sales ratio only. Okay, so you may ask this question, hey, why BIA didn't use all other of these valuations, like P ratio, PG ratio, net asset value, or the very famous one, discounted cash flow and discounted future earnings. Okay, now partly it's also because there's a lot of assumption involved. Okay, there's a lot of assumption involved. There's a lot of numbers that keeps on changing. Okay, by using all of these valuation here. Okay, but let me tell you this, knowing a lot of valuation is just nice to know. I will honestly tell you this. Okay, if you still remember in my introductory video, okay, my role here is to tell you what works. Okay, and remove anything that don't work, that won't help you make money. You want to know all the other evaluations here above, feel free to go and know, no issue. Okay, but I feel price to sales ratio is the only one, that is very simple and has been guiding us, served us very, very well, for the past 3 years here when it comes to valuing companies. Okay, because let me tell you the real truth. Okay, valuation is a very strong marketing hook. Okay, in this industry, I don't mind telling you here in this video. Okay, valuation is a very strong marketing hook. Okay, to get you guys to buy more of the other gurus program and stuff. Okay, because knowing a lot of valuation it has been marketed to say that, hey, you want to know advanced valuation. Okay, this valuation here will help you make money one. If you know how to precisely calculate the real value of the company, you will be more right than other people. Wow, something like that. Then you know the valuation you buy, you confirm will make money. This has been the pitch so far. Okay, so I don't want you guys to get trapped on this. Okay, so that's why I say it's also a way for the stock guru to show you how great they are, and let you feel you gain a lot of value. You know a lot of valuation. Wow, I know a lot of things. I'm smarter right now. Actually, no. Okay, simple is best. Okay, because in terms of valuation, think back the real reason of valuation. Ultimately, we want to buy. Okay, is to know when to buy when it's undervalued and when to sell when it's overvalued. So I say simplicity is the best policy ever. Okay, and that's why the team decided price to sales is the best. Okay, here, price to sales ratio is the best already. Yeah. If you don't believe me, I show you the results. For the past 3 years, me together with my team member, we have been guiding our communities, on just using valuation on price to sales ratio. And this is the results. Yeah. Okay, you can see 50% return year to date, 129% return, 104%, 87%. Okay, if this is not enough, I still got more. 94%, 68% return, 92% return, and 100% return. Okay, so if you think valuation, you must really think precisely, make it so complicated, then I'm afraid you are wrong. Okay, simple is the best. Okay, so the precision of buying at or lower than the stock's intrinsic value don't make you money. Okay, in case you all don't know what is intrinsic value, it's a term to say what is the real value of the stock. Okay, let me repeat now, this is very important. There's a lot of misconception when it comes to valuation. The precision of buying at or lower than the stock's intrinsic value don't make you money. Okay, why is that? Because you see, a lot of my previous members, when they started invested in 2022 before they joined BIA, wow, they go and learn all the very advanced valuation. They know discounted cash flow. They take time. They use the Excel, calculate input data. Then they found a valuation of the company, right? Okay, so all of that doesn't matter. Okay, because it doesn't matter when market crash comes. You see, doesn't make a difference. Let's say I use my own price to sales method, for example. I buy at 120, for example, and you use your precision method. Wow, okay, I calculate everything. Hey, your calculation my calculation tell me it's at 100 You buy a bit higher. Okay, but then what does it matter? At the end of the day, price crash to 50 to 40. Does it make a difference? You buy at 100, I buy at 120. Ultimately, all lose money, right? That's the thing. So valuation, precision don't give you confidence and it won't make you money. All of that won't matter when market crash comes. And that is the lesson learned in 2023 that time. And that is when you will finally realize that understanding the business knowing the potential business recovery and the management plan is far more important. Okay, so like I said here, knowing a lot of valuation is just nice to know. Ultimately, we just want to know when to buy when it's undervalued. Yes, we just want to know at least we don't overpay. Okay, it's cheap. We buy lower. Okay, but sometimes we need another assistance. If let's say the market crash way lower, sometimes market can be irrational, right? It can be go lower than the company's valuation one. So knowing your precision won't help you. But what can help you is this, your understanding of the business. Please remember this. Your confidence, your conviction comes from knowing the business. How good are you at noticing whether the business will recover or not? This is the skill, okay, I want you guys to learn. Okay, so the requirements here to use price to sales ratio, okay, there are two requirements. At least 3 years as a listed company. And of course, stable and predictable revenue. Okay, why? Because ultimately, this is the companies that we want to invest, right? We want them to be stable. We want them to be safe. Okay, we don't want any drama. So if the business can continue to grow on, this is precisely the companies that we want, right? So we just use the easiest valuation, and that is price to sales ratio. Okay, just in case, a bit of overview, what is price to sales ratio? Is we value based on the revenue that they generated. Revenue is the cleanest form ever. Because when you sell something, you get the money, that's all. That's the revenue. Because why we don't want PE ratio or discounted cash flow and stuff? Because in the middle is a lot of things happening, right? Let's say PE ratio, we take earnings. Earnings net income. It can be very erratic in the middle. If you still remember the financial statement, before that we need to minus, a lot of the cost of goods sold lah, then a lot of operating expenses lah, then we need minus taxes lah. In the middle, a lot here, everything changes a lot. So PE ratio may not be a suitable valuation. That's why we don't want any noise in the middle. So we value it based on the revenue, the cleanest ever, simple. Okay, so I'll share with you a bit of reason why we use price to sales ratio lah. Yeah, so price to sales ratio here, this is the formula. Okay, ultimately we want to know how many times the market is willing to pay, for the company's revenue. Okay, so price to sales ratio, the formula is we take the share price, and then we divide with the revenue per share of the company. Okay, so this is the formula for price to sales ratio lah. Yeah. Okay, so of course you all want to know price to sales ratio. You need to know what is revenue per share. Okay, because this is very important. Share price you all know already. Okay, but what is this revenue per share? So this we will be teaching you on the next video. Okay, so don't miss it. Okay, see you in the next one.